We are going into mid-November with a market that has been plugging along amidst a prolonged government shutdown. With limited data during the shutdown, we are seeing a mix of both positive and negative data points from the private sector. The big trend that continues to develop is that the top of the economy is still strong, while many small businesses and households are feeling the strain. It's a reminder to us that growth and even prosperity is not evenly distributed. Today, we'll briefly unpack what the latest data means for markets, and then we'll dive into a stewardship conversation about what we call the pile mentality, the subtle shift that happens when we start viewing wealth as inexhaustible. Whether it's spending, giving, or helping family, wisdom and perspective matter more than ever.
Yeah, welcome to the Wealth and Wisdom podcast where intentional planning meets an eternal perspective. It is the week of November 10th, and we're glad you're here. So Cole, let's start big picture. You mentioned some of the economic data is a little spotty right now, but we are getting this continued theme of a bifurcated economy. Can you start there and tell us what data points toward that bifurcation and what that might mean?
Yeah, boy, I think one of the most telling things is that there was a headline article in Bloomberg saying that the richest 10% of Americans account for almost 50% of the consumption or the spending in the economy. If that doesn't just obviously show the split between the people that have and the people that don't, and how they're feeling this, that inflation trend that we've been seeing, though inflation has come down off of those peaks, everything is still dramatically more expensive. And the people that worry about what their eggs and their orange juice cost, they're really still feeling it because things haven't gotten less expensive. They're just getting more expensive less quickly than they were. So that was one that really stood out to me. And then we have seen some other data points that have come in. We got the ISM manufacturing data last week. That was below consensus, which honestly isn't that surprising. The manufacturing side of things has been kind of lagging. The services, though, beat expectations and put in a new one-year high on new orders, which is a good sign for the services side of things. What I found particularly interesting was the employment. We've talked about the employment situation. We got all those negative revisions to the non-farm payrolls numbers, where we lost a couple million jobs on paper over the last few years that were initially reported and then revised off. On the private side of things, Brian, the October ADP private payrolls beat forecast, printing positive after two monthly declines. But the Challenger job cut report observed 150,000 layoffs in October. This was the most in more than 2 decades. So that's a noteworthy data point. How much does that apply to the government situation? I'm not sure. Maybe you can add a little bit of color to that. And then we saw consumer sentiment. University of Michigan does a study on this that we look at on a monthly basis. This was an unexpected decline that showed the worst level on record. There's kind of a lot there, mostly negative, though, we're kind of cherry picking what was available last week. We don't want to make too big of a thing over 1 week of data, but anything you'd add, a little color on any of those, Brian?
Yeah, I think the jobs numbers are really interesting and has big implications, not just because it speaks to what's happening, to the average family who might have job insecurity, but it also puts a lot of pressure on the Federal Reserve to take action. So you're still feeling that tension we've talked about in prior weeks between inflation still being a little bit higher than the Fed might prefer, along with economic and job data that might be moving down. So it's going to create that tension there. And we've seen the headlines. If anyone who's followed economic news the last few months, major, huge national employers, UPS, Amazon, these big employers reporting layoffs of tens of thousands of people. So you think about that has real world impact on those families. So it'll be interesting to see how this economy can absorb those folks who are going through layoffs. I'm hearing really mixed messages, Cole, when we talk to our clients who might be looking for a job. Either they're currently working and looking for something better, or some who might be in between jobs. I'm hearing some are finding work very quickly, some are struggling. So it's definitely a different job market than it was a couple years ago. And that's going to be something for the Fed to watch, and it could lead to lower interest rates, which the market typically likes. But I also think that bifurcated economy you spoke to, that top 10% driving the economy, that has significant investment implications in terms of what companies might benefit from that type of an economy when you're looking at the difference between a high-end retailer or high-end brand versus Walmart or a dollar store. Lots of different expectations and the ramifications of that K-shaped economy we've been talking about, where the top half is moving upward and the bottom half is struggling and moving downward. That's big. And then we're also starting to see that have political implications. So this whole mix of politics and markets and the economy right now, I just can't remember a time where it was all so convoluted and uncertain. So it's an interesting time. A lot of tension right now you feel right there.
Yeah, one thing you said is you mentioned that K-shaped economy. I think that was exemplified within that ADP number. I failed to mention that large firms are hiring right now, whereas small and mid-sized firms are firing. There's a very clear differentiation between the larger, maybe more stable, higher end companies versus the ones that are maybe a little bit smaller or fledgling. So it's even showing up not just on the personal side, but also corporately, which I think is really interesting. Another thing you mentioned, the government. We could be getting some traction towards the government going back to work. I know nobody's doing it intentionally, but we've had a lot of folks that have not been working, have not been getting paid. We've got several clients that I've heard of that are really feeling the weight of that. What might that do for individuals as well as the market as we get government workers, we get this flood of data? What might we expect when the government goes back to work?
Well, I wouldn't expect a huge stock market rally for one thing, because we did not get a big stock market pullback when the government shut down. You talked about it a few weeks ago when the shutdown was first announced, but historically the markets have actually been positive during government shutdown. So it's definitely not something good for the economy, but the market tends to look past that, is the way I'd look at it. So I wouldn't expect huge stock market benefit, but it does take some headwind from the economy. We're starting to see the impact. On air travel was a big theme last week, with airlines having to pull back on some flights because of less air traffic controllers and other federal jobs. So hopefully that'll be relieved. So that'll be a good release of pressure on the travel industry, for example. But also, I'm here in New Mexico, where our national laboratories are a big employer, and people are starting to wonder how the government shutdown might impact them. So you get a little bit of relief in your state and local economies that are government dependent. But again, probably not a big stock market boost there. But I think it might affect that consumer sentiment number you're talking about, Cole, where some of those folks who feel really uncertain about their government-related job can start to feel a little more certain and go back to spending, especially with the holidays coming up here. That might be important.
Yeah, and one thing that if we dust off our crystal ball as we get this this kind of pent up data that hasn't been released from the government for the last month plus, there's a reasonable expectation that we've had a nice little run in equities, even while the government's been shut down, which that's an ode to Ron Swanson and the libertarian view of less government is better, especially for capitalism. But I digress on that. But as we get this data that's going to come out, there's a pretty high likelihood that volatility will increase, whether it be to the upside or the downside on the move of the market. We're going to get, close to a couple full months of data almost all at once. Would that be a reasonable expectation as the government reopens, that things could get a little bit choppy in the market this month?
They could, and I'd be thinking more about the bond market almost than the stock market, because of everyone really hovering around that data, waiting for it to come out to predict where the Fed might go with interest rate cuts. Could they plateau here with a couple cuts under their belt, or do we move back towards lowering rates as we go into 2026? Everyone's kind of anticipating that data, hoping to get a sense of where the Fed might go going forward. So it's going to be an interesting month getting all that data pouring back in, like you said, on top of coming off of earnings season and everyone feeling pretty optimistic on corporate earnings going into the year. But again, interest rates could change dramatically, and just the general sense of the economy could be impacted by that data.
Yeah, and at this point, the bond market is giving it a 70% chance that they will cut rates going into December. Just some really interesting things being discussed. I saw that they're floating the idea of a 50-year mortgage, which is not. Yeah, there's countries that have longer than 30-year mortgages. That's not an unprecedented thing, though. I don't know that that's really going to come to pass. But you also mentioned earnings. We're over 90% through the S&P on earnings, and that has just been dramatically better than expectations, which is good. That's reporting what's already happened. That's not forward looking, but that is a good sign that earnings have been strong. We're looking at what was the number, Brian? Was it 13% is the earnings growth rate right now year over year, as compared to just shy of 8% on expectations. So equities have been moving the right way. Could there be some volatility increase on stocks or bonds, to your point? Yeah, I mean, volatility is depressed on both of those right now, so it's kind of prime for a little bit of a boost on volatility. So time will tell on that. But I'd like to shift over, Brian, and ask you about something I mentioned in the intro, that pile mentality that we had a discussion about with our investment committee this morning. To me, this kind of exemplifies in the family dynamic, how the K shape of the economy, where the people that have accumulated, the people that maybe they inherited wealth, maybe they've earned it, maybe they just got access to their retirement funds, where they've got this big pile of assets. This could be, $1 million, $5 million, whatever. It could be a lot to that particular person. What do we see happen regularly with the people that have that money? What are some common mistakes that happen when there is a pile of assets?
Yeah, and if we kind of define that pile mentality, it's the response to sudden wealth, where you see more money than you've ever seen before at one time, and it creates this mentality that the money will last forever. If you've always had $50 or $100,000 in the bank, and then you reach a settlement on a lawsuit, or you inherit $1 million, it feels like $1 million is infinite. And so when we talk about pile mentality, the language we like to use, as you know, Cole, is that we don't want to look at how big the pile is. We want to look at how much can that pile sustainably generate? What can we consistently take from that pile if we don't want that pile to go away? And unfortunately, what we know from our own experience as advisors, as well as just from statistics and studies, is that for a lot of people, that pile will go to zero. That people will actually end up, whether it's a lottery winner or someone receives a large inheritance, they tend to spend down that pile. Where I've seen it the worst is probably young people in their late teens to early to mid 20s who inherit wealth, sometimes under tragic circumstances where their parents were relatively young but passed away. And they end up with 7 figures of wealth that is gone before they're 35, which is an absolute tragedy in my mind, because that wealth could have represented a lifetime of financial security. So it's a big opportunity for us as advisors to coach people, especially younger people who might be financially illiterate or inexperienced, how to approach that pile so that they don't go through and make those same mistakes as others who have gone through that experience.
Yeah, thanks for kind of backing up and defining what the pile is, because that can be easily missed. And you gave some examples of the young inheritor of wealth, maybe a lawsuit. I had also mentioned the people that they finally retire and they're kind of unlocking this pile that they've been creating. And I think of what John Moore used to talk about, where some people look at their money as a river and some look at it as a lake. The lake would kind of be the pile, and the river is how most people, especially earners through those years where money's coming in, money's going out, whether it be to saving or giving or spending, it's kind of a hard shift when you get a pile, whether it's early on or later stages of life, because it's a complete shift on how you view money. Normally money flows like a river, but when you've got this kind of stagnant lake, it looks like it's inexhaustible. It looks like you could never possibly drain that lake, but you start getting enough little offshoots, little rivers coming off of that are flowing out and nothing flowing in. It's amazing how fast that money can go. I think of some previous clients that actually have left. Unfortunately, I hope they're doing okay, but where wealth was created and they thought, man, I've got this pile, and they came to us saying, can I buy this thing? Can I buy this property? Can I do this? And our advice was no, because you talked about the sustainable amount you can generate off the pile? How much can you sustainably, let flow out? Maybe you've dammed it and you can let that flow out of the lake or the reservoir. And they didn't like that answer. They wanted to say, yes, I can spend it because it's inexhaustible. Have you seen examples of that, whether it be inheritors or settlements or whatever that might be?
Yeah, and I think the key there, we've talked about young people, but you don't have to be 25 to make those mistakes, right? It's really just a human behavior issue where the greed sets in a little bit. You see this pile and you want nice things. And I'll note too, it's not always about wanting more possessions. I think it can be about possessions, and we're certainly warned about possessions in Scripture. If you look at Luke 12:15 says, life does not consist in an abundance of possessions. We're not supposed to seek out and find joy and satisfaction through lots of stuff. But sometimes what we see is it turns into helping the kids. Maybe someone in their 60s or 70s inherits wealth, and then they turn around and start pouring money into their children. And there, even if it's a sustainable rate, you have to ask, is that something that's really in the best interest of that next generation? Are you creating a lifestyle for them that is unsustainable if you were to pull back that support? Or we see people become like the bank of mom, as we call it sometimes, where we've seen this either on an inheritance or sometimes there's a couple and the husband passed away or the wife passed away, whoever was maybe the primary financial person in the couple. And the surviving spouse sees the lump sum and has never really stewarded that wealth because that role was left to the spouse that has now passed. And as a result, everyone's calling them for money. We have one client whose husband passed away and quickly was making loans to every family member that needed a house or a car or anything like that and became the bank of mom. There's always a risk there that you change the family dynamics. So it's not just a money issue. You can change relationships and also maybe not get paid back, and then you have resentment. There's a lot of things that can go wrong here. It's an area, honestly, Cole, where we've seen so much in this space, serving hundreds of families with all these different experiences, that our training certainly helps here, but our experience almost matters more because we have just an endless number of stories, it seems, about pile mentality going wrong.
Yeah, I think that's so true. We were just talking about it this morning, and one of the examples is you almost think of like a professional athlete where they get this big signing bonus, and whether they're young or old, whoever it is, they get this money. And it was actually mentioned today that the first thing they want to do is they want to help mom and dad and aunt and uncle and their friends and their teachers. And it's a great, generous heart. In some instances, it can feel almost noble or righteous to want to help and pay it forward or pay it back to folks that have helped you get to where you are. But really, you're undermining the foundation for everything you have in place for the future. And there's a real big stewardship lesson here that you really have to take stock of what you have and what that really means for you or anyone else moving forward. If you exhaust that, you're no longer a resource to anyone, including yourself. So it really is. The Bank of Mom hit home with me. I think about a woman that I get to serve here, where that's been her story. And it's hard because it's not really that there's a deep-rooted desire that she wants to be helping. It's a feeling of commitment or obligation or guilt that then leads her to give. And frankly, it's a sustainable amount, but it's not really bringing her joy. That's one of our principles with giving is, does it bring joy to you and the person or the nonprofit, the place that does it give joy to you and the end recipient? And oftentimes you can't answer that as yes on both sides. And that's a pretty good indicator that just from a contentment and heart posture, you shouldn't be doing that giving or spending. Anything else you'd add to that, Brian?
I would just close it out with sort of two questions you can ask yourself if you are the recipient of sudden wealth. And the first is, as you're making decisions with that wealth or as you're considering your plan, are you making wise decisions that are sustainable and aligned with your purpose? Is it really your priority to spend where you're considering spending? And then if you are engaging the next generation or a family or a friend in support, ask yourself, does this gift, does my support strengthen that person's character and strengthen their wisdom and stewardship, or weaken it? Am I providing a crutch or an unsustainable lifestyle for that person? Really, if you're going to answer those two questions well, great. This is where advisors can be really helpful because we can help you answer those questions. But I think to slow down and ask those questions puts you way ahead of the average person who might suffer from that pile mentality.
Yeah, there's a lot of wisdom there. So thank you so much for joining us on the Wealth and Wisdom podcast, where intentional planning meets eternal perspective. If you found today's conversation helpful, please take a moment to like the video, subscribe to the channel, make sure you're getting notifications, and share it with someone who might benefit from this. For more resources and timely insights, please visit the Insights page at johnmoore.com, where we regularly share articles, videos, and tools to help you steward wisely. We'll look forward to seeing you all next week.